Have you ever wondered why your most confident trades often turn into your most painful losses? Why the trades that feel obvious in the moment somehow collapse the fastest? This is not bad luck. This is not manipulation. This is not because the market is against you. This is because urgency is the enemy of discipline. To make a long story short, the faster you decide, the weaker your decision becomes. Most traders believe their problem is strategy. They jump from indicators to indicators, from mentors to mentors, from one holy grail to the next. But let's ask an uncomfortable question. If strategy was the real problem, why do traders break their own rules even when they already have a strategy? The answer is impulse. According to Dalbar's quantitative analysis of investor behavior, the average retail investor underperforms the broader market by several percentage points every single year. Not because they pick bad assets, but because they enter and exit at emotionally terrible times. Fear and greed, not logic, dominate timing. Now pause for a moment and think about your own trading history. How many losses came from trades you carefully planned days in advance? And how many came from trades you entered because price was moving fast and you felt you had to act? That feeling of, I can't miss this, is not intuition, it's biological pressure. When markets move quickly, your brain activates the amygdala, the part responsible for fear and reward. This part of the brain is excellent for survival, but terrible for probability-based decision-making. Logical thinking lives in the prefrontal cortex, and here's the problem: it needs time. When you trade instantly, you are literally cutting logic out of the process. This is why impulsive trades feel exciting before entry and terrifying after. And this is exactly why the 72-hour rule exists. The rule is brutally simple. Any trade idea that is not already written in your trading plan must wait 72 hours before execution. No exceptions, no shortcuts. Why 72 hours? Because impulses decay with time. Emotions cannot sustain themselves indefinitely without reinforcement. Excitement fades. Fear cools down, and when that happens, clarity returns. A study published in the Journal of Behavioral Finance showed that traders who delayed execution significantly reduced decision errors, not because they became smarter, but because emotional intensity dropped. Here is a powerful truth most traders don't want to hear. If a trade disappears after 72 hours, it was never a good trade, it was a reaction. Markets don't reward speed, they reward selectivity. Professional traders understand this deeply. Institutions don't chase candles. They wait for confirmation, structure, and alignment. They expect most ideas to fail before execution, and they are completely fine with that. Why? Because avoiding bad trades is more important than catching every move. Retail traders, on the other hand, are trained to believe that missing a trade is a loss. This mindset alone destroys discipline. Let's make a comparison. Impulsive trading is like fast food. It's cheap emotionally, instantly satisfying, and addictive. Disciplined trading is like long-term fitness. Slow results, uncomfortable at first, but life-changing over time. One destroys you quietly, the other compounds quietly. Ask yourself this question honestly: how many trades did you take simply because you were bored? Boredom is one of the most dangerous emotions in trading. When nothing happens, the mind creates urgency. It starts looking for action. The market becomes entertainment, and trades become dopamine hits instead of calculated risks. This is why the 72-hour rule feels uncomfortable. It kills excitement. It removes stimulation. And that's exactly why it works. Discipline is not about forcing yourself to behave better. That approach always fails. Discipline is about designing rules that make bad behavior difficult. The 72-hour rule introduces friction, and friction is deadly to impulsive decisions. Here's another uncomfortable question. If this trade is truly high quality, what exactly am I afraid of losing by waiting? Usually the answer is ego, not money. Waiting exposes weak logic. It reveals poor risk-reward. It forces you to confront downside. And many trades cannot survive that examination. That's a gift, not a problem. Because every trade you don't take impulsively is capital preserved, confidence protected, and discipline strengthened. This is where the real journey toward unshakable trading discipline begins, not with indicators, not with strategies, but with time. Let's talk about something traders rarely admit. Waiting hurts more than losing. Think about it. A loss at least gives closure. You're angry, disappointed, frustrated, but the decision is done. Waiting, on the other hand, leaves you in uncertainty. And the human brain hates uncertainty. This is exactly why most traders break their own rules. To make a long story short, waiting forces you to sit with your emotions instead of escaping them. From a psychological standpoint, this makes perfect sense. Your brain is a reward-seeking machine. When markets move fast, dopamine is released, the same chemical involved in gambling, social media addiction, and video games. Fast candles, breaking news, and urgent alerts all spike dopamine, and dopamine doesn't care about profits. It cares about anticipation. This is why traders feel most excited before entering a trade, not after winning one. The moment you enter, uncertainty replaces fantasy. The dream of profit becomes the risk of loss. So what does the brain do? It tries to enter faster next time to chase that feeling again. According to behavioral studies in finance, overtrading is one of the strongest predictors of long-term failure. Research consistently shows that traders who trade more frequently perform worse than those who trade less. Not because they see fewer opportunities, but because they act on weaker ones. This brings us to a dangerous illusion: activity equals productivity. In most jobs, doing more means earning more. Trading is the opposite. Doing more often means making more mistakes. Yet the brain doesn't understand this. It craves action. So when you decide to wait 72 hours, you are not just delaying a trade, you are cutting off dopamine. That's why it feels uncomfortable. That's why your mind starts negotiating. It might run without me. This setup is different. I'll just enter small. I'll regret missing this. These thoughts are not analysis. They are withdrawal symptoms. A study published in the Journal of Behavioral Finance found that traders who delayed execution experienced a sharp drop in emotional confidence, but an increase in decision accuracy. In simple terms, they felt worse, but performed better. This explains a painful truth. Good trading often feels bad in the moment. Bad trading feels good at first and terrible later. Now let's address another major problem: time distortion. When you're watching charts, time feels compressed. 5 minutes feels like an hour. One candle feels critical. The brain exaggerates importance because attention is focused. This is why traders convince themselves that waiting will cause them to miss the move of a lifetime. But statistically, this is nonsense. Markets are not rare event machines. Opportunities repeat endlessly. The idea that this trade is your only chance is emotional storytelling, not reality. Ask yourself this question honestly. How many once-in-lifetime trades have you already seen this year? Exactly. The 72-hour rule breaks time distortion. It forces you to zoom out. When you revisit the same chart after 3 days, something magical happens. The chart shrinks emotionally. What felt massive now looks ordinary. What felt urgent now looks optional. This is not because the market changed. It's because you did. Another critical effect of waiting is that it exposes poor reasoning. Many impulsive trades are supported by vague logic. It looks strong. Momentum is crazy. Everyone is buying. After 72 hours, vague logic collapses. You are forced to articulate exact reasons: entry, invalidation, risk, reward. Most impulsive ideas cannot survive this scrutiny. And here's the part most traders don't expect: waiting often improves entries. Price pulls back. Volatility settles. Structure becomes clearer. Even if the trade is still valid, execution usually becomes cleaner. Stops get tighter. Risk improves. So waiting doesn't just remove bad trades, it upgrades good ones. Now let's address fear. Many traders say, if I wait, I'll miss it. That's not fear of missing profit. That's fear of missing validation. The validation of being right, of catching a move, of proving something to yourself. The market doesn't care about your validation. Professional traders understand this deeply. They don't measure success by how many moves they catch, but by how consistently they follow process. Missing a trade is irrelevant. Breaking discipline is unacceptable. This is why institutional traders survive and retail traders churn. The 72-hour rule forces a subtle but powerful identity shift. You stop seeing yourself as someone who reacts to markets and start seeing yourself as someone who evaluates markets. That shift alone changes everything. You stop chasing. You stop forcing trades. You stop needing the market to entertain you. And once that happens, discipline stops feeling like punishment and starts feeling like control. Because the truth is simple: the market is always moving. Your capital is not infinite. Your discipline is the real asset. Let's break a dangerous myth right now. Markets don't destroy accounts, decisions do. Two traders can look at the same chart, the same time frame, the same news, and take the same trade. One walks away calm and consistent. The other walks away frustrated and confused. The difference is not intelligence. It's timing of decision-making. To make a long story short, when you decide matters as much as what you decide. Impulsive trades are born in moments of emotional intensity. Price is moving fast. Volume spikes. Social media explodes with certainty. And suddenly uncertainty feels unbearable. Your mind fills in the future before it happens. This is not analysis. This is projection. Behavioral finance explains this clearly. Humans are pattern-seeking creatures. When something moves quickly, we assume continuation. This bias is called recency bias, the tendency to overweight recent information and ignore long-term probabilities. In trading, recency bias is deadly. A study by Barber and Odeon showed that frequent traders significantly underperformed the market, largely due to overconfidence and reactionary behavior. These traders weren't wrong about direction, They were wrong about execution. Now let's compare two traders. Trader A sees a breakout and enters immediately. The trade feels obvious. Confidence is high. Position size creeps slightly higher than planned because this one looks strong. The stop loss is placed wide or mentally because being stopped out would feel embarrassing. Trader B sees the same setup but writes it down and waits 72 hours. 3 days later, something powerful happens. The emotional charge is gone. The chart no longer looks explosive, it looks structured. Levels become visible. Resistance appears. The trader notices things that were invisible during excitement. Sometimes the setup disappears. And that is not a loss, it's capital preserved. Sometimes the setup weakens. Risk-reward shrinks. The trade is skipped, and sometimes, this is important, the setup improves. Price pulls back. Volatility settles. Entry becomes cleaner. Stop becomes tighter. The same idea now carries less risk, same market. Same idea. Completely different outcome. This is the invisible edge of time. According to data from eToro's retail trading behavior reports, overtrading during high volatility periods is one of the largest contributors to retail losses. Fast markets trigger faster decisions and faster mistakes. Waiting breaks this loop. Here's another uncomfortable truth. Most impulsive trades are supported by weak logic disguised as confidence. Statements like, "It's obviously going higher," "This move is strong," "Everyone is buying." These are not reasons. They are emotions looking for permission. The 72-hour rule forces you to replace emotion with structure. After 3 days, you must answer specific questions. Where is my invalidation? What is my exact risk? What would make me not take this trade? Most impulsive ideas cannot survive this interrogation. This is where intention replaces impulse. Intention is calm, it's boring, it's precise. It doesn't need urgency to exist. Impulse, on the other hand, needs speed. It collapses when delayed. This is why traders who wait feel less confident, but perform better. Confidence in trading is often the enemy. Overconfidence increases position size, loosens stops, and justifies rule breaking. Professional traders are not confident in outcomes. They are confident in process. This distinction changes everything. Another critical effect of waiting is risk realism. When emotions cool, risk becomes heavier. A loss feels more real. And when loss feels real, position size becomes more reasonable. Ask yourself this honestly. How many trades would you never take if you fully accepted the loss before entering? Waiting forces that acceptance. This is why discipline feels uncomfortable. It removes fantasy. Fantasy says, "This trade will work." Discipline asks, "What if it doesn't?" And that question alone saves accounts. The market doesn't reward bravery, it rewards humility. The 72-hour rule builds humility into your decision-making. It reminds you that you don't need to trade every move. You don't need to prove anything. You don't need to be right all the time. You need to be consistent. Consistency is not about winning more trades. It's about losing less money when you're wrong. And the fastest way to lose less money is to stop entering trades you never should have taken. Time exposes truth. Bad trades can't hide when you wait. Weak logic collapses. Emotions burn out. And what remains is something rare in retail trading: clarity. Let's face it, trading is full of opinions, hot takes, and emotional storytelling. Everyone has a reason why the market should move one way or another. But reality is simple. Numbers don't lie. The most reliable evidence we have about retail trading comes from hard data. According to a Statista study, over 90% of day traders fail within the first year, and over 80% quit within 2 years. Most of this failure is not about strategy. It's about behavior, specifically impulsive decision-making. Another example comes from research by Barber and Odean, who studied the impact of overtrading on returns. They found that traders who traded the most frequently underperformed the market by an astonishing 5% annually, largely due to overconfidence and reacting to recent price action rather than fundamentals or proper risk management. What does this mean in real terms? Imagine two traders with the same capital. Trader A jumps into almost every opportunity, chasing the excitement of the market. Trader B filters trades using the 72-hour rule. Trader A will constantly take weak setups, over-leverage, and pay more in fees. Trader B will avoid bad trades, size properly, and preserve capital. Even if Trader B misses a few opportunities, the cumulative effect of avoiding losses and improving execution outweighs any potential gains from impulsive trades. Waiting does not reduce opportunity, it increases probability. A study published in the Journal of Behavioral Finance confirms this. Traders who delayed execution by even 72 hours reduced impulsive errors by nearly 30% simply because they reassessed setups with cooler emotions and more rational thinking. Now, let's translate this into daily trading psychology. Most traders confuse activity with productivity. They feel compelled to act, believing missing a trade is a failure. This is a dangerous trap. Markets are not scarce. Opportunities repeat endlessly. But capital and emotional energy are finite. Ask yourself, how many trades have you taken this week just to feel active? If you analyze your results honestly, the trades driven by that urge are likely the ones that cause the most damage. Waiting acts as a filter. It forces a pause, a mental checkpoint where you must answer critical questions. Does the trade align with my plan? Is my risk-reward acceptable? Can I explain my entry and exit rationally? If the answer is no, the trade dies. That's capital preserved. That's risk avoided. The 72-hour rule also reduces recency bias, one of the most destructive cognitive biases in trading. Recency bias is the tendency to overweight the most recent price action and assume trends will continue indefinitely. Waiting allows the brain to reset and see price objectively without being clouded by excitement or fear. Let's talk math for a moment. Imagine a setup that has a 50% chance of success emotionally perceived as 80% because excitement inflates confidence. By waiting, you reassess, reduce bias, and the setup now truly reflects a 50% probability. That small shift in clarity is enough to prevent repeated mistakes that compound losses over time. This is also why professional institutions survive and retail traders fail. Institutions don't chase every candle. They follow process. They allow time to filter out noise and improve execution. Retail traders often react to emotion first, logic second, or never. The key takeaway is simple. Time is the ultimate lie detector. Bad trades cannot survive a 72-hour review. Weak setups are exposed. Emotional overconfidence diminishes, and you are left with clarity, structure, and selectivity, the true edges in trading. Waiting doesn't feel fun. It doesn't provide instant gratification. But it is the single most effective tool for transforming impulsive behavior into consistent, disciplined trading. By now, you've seen how the 72-hour rule filters bad trades and improves probability. But there's a deeper effect that's even more powerful. It rewires your trading identity. Most traders define themselves by action. I am a trader because I trade. And that's where the trap begins. Your sense of self becomes linked to activity, not results. When your self-worth is tied to speed, every market move triggers urgency. You chase candles, impulsive ideas, and social validation. You start gambling, not trading. The 72-hour rule changes this dynamic. It shifts your identity from reactive trader to deliberate decision maker. Here's how it works psychologically. Impulse is neutralized. When you delay a trade, the emotional intensity fades. Fear of missing out, excitement, and urgency all decrease. If your account is 50,000, that's 500. This number is sacred. It's not negotiable. If a trade could potentially lose more than this, reduce your position size. Step 3. Set stop losses or exit points. A stop loss isn't just a technical tool, it's a psychological insurance policy. It ensures that if the market moves against you, losses are limited automatically. For example, if a stock is trading at 100 and you're willing to lose 500, your stop loss might be at 95. Step 4. Adjust for volatility. Not all markets behave the same. Cryptocurrencies are far more volatile than large cap stocks. Forex can swing wildly in minutes. Commodities can gap overnight. The 1% risk must always be calculated based on actual volatility, not arbitrary numbers. You may need fewer units in volatile markets to maintain the same 1% risk. Step 5. Leverage responsibly. Leverage magnifies risk. If you're using margin or futures, ensure your actual loss in dollars never exceeds 1% of total capital, regardless of leverage. Many traders fail here because they focus on position size without considering leverage. Step 6. Track your risk-adjusted performance. It's not enough to see profits or losses. You must analyze performance based on risk taken per trade. Over time, you'll see which strategies generate the best returns relative to the risk you assume. This is how professional traders measure success, not by raw gains, but by gains per unit of risk. Now let's look at how this protects you during real crashes. Imagine the market drops 30% in a week. Without a risk cap, panic sets in, losses compound, and portfolios can collapse. With 1% risk, your largest positions may only lose 1-2% individually. Your portfolio may be down 5-7% overall, not catastrophic. You maintain liquidity, confidence, and the ability to buy assets at discounted prices, turning market panic into opportunity. Ask yourself if survival gives you the chance to buy at lows. Isn't limiting losses the ultimate form of opportunity creation? Next, we consider position sizing across multiple trades. Many investors risk 1% per trade, but if they hold 50 positions simultaneously, they effectively risk 50% of their capital at once. This is called portfolio risk aggregation, and ignoring it is a common mistake. The solution: calculate total potential loss across all positions. Keep it within a maximum threshold, e.g. 5-10% of your portfolio. This ensures even multiple losing trades don't create catastrophic drawdowns. Now let's talk about mental discipline. Even with perfect numbers and formulas, humans often violate rules. FOMO, greed, or overconfidence can lead to oversizing positions. This is where automation or pre-set stop losses help. The 1% rule only works if it's non-negotiable. Think of it like a seatbelt. You don't remove it when the ride gets bumpy. Historical examples highlight this vividly. During the 1987 crash, portfolios with strict risk limits survived and capitalized on post-crash rebounds. Those without limits often suffered losses exceeding 50%, many of which were never fully recovered. Now, let's discuss scaling over time. The 1% rule doesn't limit growth. It preserves the ability to grow consistently. By risking a small, controlled percentage, your account can survive losing streaks, take advantage of winning streaks, and compound steadily. Over decades, this disciplined approach can produce wealth that reckless short-term trading never achieves. A simple numerical illustration: portfolio, the 50,000 risk per trade, 1% average winning trade through and losing trade 1%, even with a 50-50 win-loss ratio. Consistent application produces growth, while surviving drawdowns ensures you stay in the game long enough for compounding to work its magic. Now let's address psychological resilience. When your largest position can only hurt you 1%, your brain stops overreacting. You make decisions rationally. You follow your system. You avoid panic selling. Emotional stability often turns small edges into long-term dominance. Finally, let's connect this to the concept of drawdown protection. The 1% rule is essentially an insurance policy against large drawdowns. By controlling risk on every trade, you ensure no single mistake can erase years of progress. Data from multiple decades of market performance shows that portfolios with controlled risk outperform during turbulent periods, even if they underperform slightly in stable bull markets. The key takeaway: the 1% rule is not a limitation, it's freedom. Freedom from fear, from panic, from destruction. And freedom is the ultimate advantage in investing. Next, we'll break down specific examples of 1% rule implementation in stocks, crypto, and forex, showing exact calculations, position sizing, and stop-loss strategies that allow you to survive drawdowns up to 50% and beyond. Now let's dive into real-world examples of how the 1% rule works across different markets. Seeing numbers in action makes the concept far more tangible. Example 1: stocks. Imagine a 100,000 portfolio. You identify a stock trading at 50 with a technical setup suggesting potential upside, but also volatility. You're willing to risk 1% of your portfolio on this trade. That's 1,000. You calculate the stop loss at 45 per share. That's a 5-hour loss per share. To risk 1,000, you buy 200 shares. If the stock hits the stop loss, your maximum loss is 1,000. Even if the market collapses tomorrow, your portfolio is down just 1%, manageable, survivable, and psychologically intact. Now, let's contrast this with ignoring the rule. Risking 10% of your account on the same trade with identical stop-loss placement means 2,000 shares. The same price movement triggers a 10,000 loss, 10% of your capital, creating stress, panic, and possibly forcing emotional mistakes in other positions. Key takeaway: risk per trade dictates survival, not just strategy accuracy. Example 2: cryptocurrency. Crypto is far more volatile than stocks. Let's say you have a 50,000 crypto portfolio. Bitcoin is trading at 30,000 but can swing 30,000 intraday. You apply the 1% rule: maximum loss per trade 500. With 3,000 potential drop per unit, you buy only 0.66 BTC. If Bitcoin drops 3,000, your loss is 500. Without this rule, buying 1 BTC at 30,000 exposes you to a 3,000 loss, 6% of your total portfolio, instantly putting you under psychological and financial pressure. Even during extreme drawdowns, like March 2020 or late 2017, this small exposure ensures survival. You can withstand multiple losing trades in a row without forcing liquidation or panic exits. Key insight: volatility magnifies the need for strict position sizing. Example 34x Forex allows massive leverage, sometimes 51 or more. Suppose you have a 20,000 account and trade EUR/USD with 50v1 leverage. A standard pip movement can create gains or losses far exceeding your unleveraged capital. By applying the 1% rule, your maximum risk per trade is 200. You calculate the lot size to ensure that even with leverage, the most you can lose is 200 if your stop-loss triggers. Without this discipline, just a single adverse movement could wipe out 10-20% of your account. With repeated trades, a margin call or account blow-up is almost guaranteed. Key insight: leverage doesn't replace risk management. It magnifies mistakes if the 1% rule isn't applied. Now let's discuss portfolio aggregation, because many investors apply the 1% rule per trade but ignore total exposure. Suppose you hold 10 positions in different assets, each risking 1% individually. Total potential loss is not automatically 10%. Correlation between positions can amplify losses. Stocks in the same sector, altcoins tied to Bitcoin, or currency pairs moving in tandem can create hidden portfolio-level risk. Professional traders calculate total potential loss across correlated positions. They may adjust individual risks to 0.508% to keep total potential drawdown within a safe 5% threshold. This prevents cascading losses even during systemic market crashes. Now, let's look at psychological resilience in action. Imagine a trader applying the 1% rule during a sudden market crash, a 20% drop in a day. Positions hit stop, losses one by one. Each loss is small, predictable, and manageable. The trader remains calm, evaluates opportunities, and can even buy assets at temporary discounts, turning volatility into advantage. Compare this to a trader ignoring the rule. The same crash wipes out 20–30% of their portfolio. Panic ensues. Emotional decisions follow. They may exit all positions, missing the recovery that occurs within days or weeks. Losses compound, not just financially, but psychologically. This is why survival is more valuable than prediction. Next, let's consider compounding over time with the 1% rule. Even with modest returns, protecting capital allows exponential growth. Portfolio to $50 average winning trade, 2% maximum risk per trade, 1% even if only 50% of trades are winners. The portfolio steadily grows while remaining protected from catastrophic drawdowns. Now consider a high-risk approach, 10% per trade, same win rate. One losing streak triggers a 30–50% drawdown. Recovery is slow, compounding is interrupted, and psychology is shattered. Mathematically, the 1% rule turns volatility from an enemy into an ally. You take small losses, let winners run, and survive to compound over years. Finally, let's address a common misconception. Many investors fear the 1% rule limits returns. They believe big profits come only from big risks. Reality check. Long-term wealth comes from surviving market cycles. Limiting per trade losses ensures you stay in the game long enough for small, consistent gains to compound into significant wealth. Rhetorical question: would you rather risk it all for a single moonshot or preserve your portfolio to profit from every opportunity that comes over decades? This mindset separates gamblers from true investors. Next, we will explore how the 1% rule protects against multi-asset crashes, including correlated markets, black swan events, and systemic risks, ensuring you can survive a 50% drawdown without ever panicking.